All right, this is Mackey's Retail Roundup Live. Spencer Israel from Stock Market TV. That's Jeff Mackey from Mackey's Retail Roundup. Jeff, how we doing?
We're doing shockingly well, Spencer. I'm not going to
Great.
lie. If we backed it up like a month ago, and I'd put the over under at like hanging in there. How am I doing? I'm
Hey,
hanging in there, Spencer. Things are okay. We've battened down the hatches. But actually things are going. We had a little welcome back party for my money. That was nice. Through that
that's
in kind of
great.
mid-April, it's like, hey, welcome home, fellas. Let's go. Let's go. Discretionary spend.
That's great.
We've kind of undone the tariff, which is our segue, and I think the market agrees. So we're all doing just fine.
All right.
It's
Well, let's
amazing
talk
how
about
mollified we
what we
are.
learned, and then for the next few weeks, we're going to be this week and the next week and maybe the week after. We'll be doing a lot of retail discussion because we've reached the retail part of earnings season, so we'll be doing a lot of earnings stuff. But before we get to the earnings for now, let's just talk about what we learned this week. What did we learn, Jeff?
The company's hung in there. It's not that bad with a huge yet out there. There's always the yet dangling out there. But what we really learned is kind of the companies, at least the consumer facing ones, they kind of just went through something pretty similar with COVID, just this sort of random effective shutdown. There's differences, obviously, because this is so self-inflicted and kind of just bizarre. But once you get past that, it's like, well, you close the supply chain, you got to move stuff around. The companies they're quantifying that. I say it over and over again because my two working theories of this market are: once we kind of see the damage, it's going to be less scary than it is in the abstract, because I think it'll be better than just a complete freezing of the entire supply chain. That's a low bar. And two, as we kind of get through it and companies pick through it's that's incrementally bullish. We've lowered expectations so much that anything short of just a dead ass freeze has been received pretty well. And so now this has gone from a just terrifying downward catalyst to, yeah, I get the PEs are high. Why? Because we freaking are just declared a trade war. So I expect every stock to miss. And once you expect every stock to miss, well, the ones who beat, they look pretty damn good.
We got a trade deal with the UK apparently this week. I saw a headline that shipments from China have already started to resume in some form, so things are looking up there.
80% tariffs from China. That's where we are, right? It's like I've just been slamming my private parts in a car door for the last 3 days. I switched to my toe with these 80%. It hurts much less. Geez, I can't believe how much nicer this is. Boy, that don't slam it on your junk. Let me tell you, if you have a choice, you want to lean towards your foot. But that's where we are. Again, not very good news is actually incrementally much better than it was before, and that's what you're seeing. At least that's what they're reporting. You would expect a lot of train wrecks. There's every excuse in the world for a company like Starbucks to have just crapped the bed 9,000 ways, and they kind of didn't. The big boys, the Amazons of the world, they kind of shrugged it off, and so we've relieved the real kind of death concerns of, okay, once the port's low, the store shelves are going to be empty. And better than that is kind of good right now. So the stocks are behaving accordingly. It's not bad.
All right, before we get to the report card, Jeff, what about the three most overused words on Wall Street? Just you wait. Just you wait, though. We haven't seen nothing yet. I don't know.
That's the smarts. I love fading the smarts, and I
Yeah.
talk to smart people and stuff. But yeah, there's a huge just you wait. There is a huge sort of Damocles hanging over us because they really will shut down the ports. It really, like, all this stuff is a genuine problem, and it's all about to hit the fan. But take the over on global calamity. If it is the apocalypse, there's nowhere to cash in, and historically, kind of, maybe Buffett called the top. It would be awesome. It would be kind of poetic to have like Ben Franklin kick us off and Buffett just be like, peace out. We've been capitalism. Woo! Tip your waiters. That would be poetic, but it probably won't happen right away. And there'd be some good longs on the way.
All right, let's talk about some earnings report cards here. Like I said, we have reached the retail portion of the earnings season. We obviously already had we had Amazon, that was last week. We had so this week we had what we had Peloton. You've got Hasbro on it. You got Spotify on here. So high level here. Let's kind of walk through a few of these.
High level's pretty good. It's again the second half of the Fed. Things aren't a complete disaster out there, and that was really Peloton's quarter. What I was looking for them was low churn, which indicates that kind of the upper middle level people that are customers there, as well as the greatest athletes in the world, Spencer, are Peloton riders. And but they aren't canceling. 1.8% churn is really good. Like if it was a truly bad economy, you would see a slowdown. That'd been some of the concern. They did creative stuff with their supply chain. I get that people are taking the stock lower, but it was fine. And that's not a company that's fine if you're in a real deep recession. Pepsi has other problems. But again, things could have been terrible. A month ago, you would have thought there'd be a lot of warnings. Not everybody's even pulling their outlook. Disney beats some guys higher. No one had that in their playbook. How they did it, grabbing the bag from Abu Dhabi, okay. That's an unusual move from the Walt Disney Corporation. It's welcome friends and family, but congratulations, because they are going to make so damn much money off that deal. It's just sick. It's a licensing deal. Disney shows up and says, this roller coaster looks great, and they get paid $5 billion a month for it.
Sounds good to me.
Yeah, me too. Nice work if you can get it, right? It's sure, it looks enough like Space Mountain to us. There's like a Louvre in Abu Dhabi, and apparently Iger went over there and he's like, "Holy crap, this is an amazing Louvre knockoff," and everyone was just fine with that. It's not, but no one ever accused Disney of really appealing to that highest snooty taste factor. So knockoff Louvre and a fake Disney, it seems like okay, and the company's going to make a ton of money, and the stock's higher.
Disney in Florida gets pretty gross in the summer. I'm imagining Disney in Abu Dhabi in the summer are going to be equally gross.
It's going to be hot. It'll be a dry heat, Spencer.
Yeah, that's right. That's right. That's what they tell me. It's
nice dry heat.
Different. Yeah,
like a hair dryer.
All right. This was interesting, Jeff. We haven't really seen a whole lot of M&A really it's been a minute. The M&A gears, the IPO gears have kind of slowed to a halt, but we got a big one this week. Skechers going off the board, private equity deal with a healthy premium. This thing is remind me of the price. It's like $61 a share.
Healthy-ish. They took it out for 63. It was 74 a month and a half ago. There's a few moving parts on this. Really good company. And terrific run. Robert Greenberg, he doesn't get a lot of talk. He's a shoe dog. He founded LA Gear. If you remember them, you probably don't. They were probably a blink in your parents' eye. Your parents probably met wearing LA Gear shoes if they were really hipsters in the 80s. But he just had a huge run of success, and I think part of it is he's 85. They offered him over $1 billion and said, "Would you want to deal with this or fight the tariffs for the next 5 years?" And he also decided the money was the better part of valor. But it also, whether or not he's a legend, no one's going to cash him out if the PE guys are that worried. That puts a floor under a lot of different companies out there. We're going to talk about it as we get into it. But if there's actual acquisitions to be made, you've really boot stomped a lot of these consumer names. A lot of the names that we're going to talk about that are reporting over the next week have been just crushed. And maybe if you have deals out there, they're worth more than they're being priced right now.
Well, is some of that the fact that like the public market is pricing in future earnings or lack thereof, and these private equity deals are based on current balance sheets? Is that part of this?
Yeah, it's just a cash flow story. How would you run it private is the way to think about it. So it's you can punch ahead a couple and you look at like a company like Callaway. If you're going to run a company like that on the private side, you play it slow. You don't try to jam through growth where you don't have it. And you just collect cash until the economy's better. If you're public, you always got to pretend to be growing. And you always got to, in the case of Skechers, they're not going to be growing. They came out with their earnings release 2 weeks ago, and the earnings were fine. They pulled the rest of the year guidance because they said, we make half our shoes in China, 40%, give or take. We can flex around. We're a global company. But the subtext was very much, this is going to be a huge pain in the ass, and we don't know what we're going to earn next quarter. So why would we, offer an estimate, which doesn't really fly that much on Wall Street, whether you respect it or not. But that's an honest answer, and that's a private company answer. That's not an answer for someone that wants to be public. So he cashes out for $1 billion. But Texas Pacific Group, they're respected, smart guys. If they're in there bidding, some of these other companies are going to get a fine. They're going to get a nibble.
That's That's exactly right. Because usually, these things tend to happen in waves, and like you said, A, kind of puts a floor here, and B, if there's one private equity firm sniffing around a shoe company, chances are there are others sniffing around other companies, right? So we may see more of this, and that's a good thing because M&A activity, IPO activity, all these transactions, all these deals is a sign of money flowing through the system and a sign of risk appetite, right? So you want to see
Yeah, and
this.
it's pretty dead, man. It's poke it with a stick dead out there in terms of MMA. And so just to see any activity at all, that is fantastic.
That's right.
You can't make too much out of it because of the players involved. He's leaving a really good company. There's a lot of kind of distressy type of deals. I'm not sure there's an appetite for that.
Right.
But if you're Texas Pacific, it's like this thing's 40% off. It's trading at 10 times earnings. It's well managed because this guy's a legend. We cash him out and we just run it for cash. That's a smart thing to do.
All right. That was a surprise. What's not a surprise is the earnings calendar. We know what's coming next week. We will hear from Walmart. That's the big one, right? They're Thursday before the bell. And then that leads us into I guess, the big box retail portion of the earnings season the following week with Home Depot and Target and TJX and BJ's and Lowe's, all those other big names. So is Walmart kind of the big one for you?
Walmart's a big kahuna.
Yeah.
It's. I think that Daytona 500 is the first NASCAR race. Walmart gets things started, and they fall in order. So if you're Target, you don't want to report before Walmart. You want to have that kind of context. And so by design, yeah, as far as I know, there's no law for it, but everyone waits until Walmart decides they're going to report and follows thereafter. See the same thing with Home Depot and Lowe's. It's if you're Lowe's, you want to have just, you're going to be kind of, your results are relative to Home Depot's. There's no getting around it, so you might as well accept it. And then you get the flotsam and jetsam of the entire mall. We got a couple scrappier companies kind of leaking out earlier. We got a classy Swiss company and a couple pretty American ones. But for the most part, things kick off Thursday.
All right, let's look ahead. And as a reminder, we're going to do this stream again, I think on Wednesday, Jeff, and we'll talk more about these reports as they come in. But let's kind of look ahead here. So you mentioned Callaway just as a hypothetical before, but they're on the calendar here. What are you thinking?
They need a deal so bad, and they should get a deal. It's a golf club company and a really good one. Everyone knows Callaway. This is like, geez, I just took up golf. I'm so excited. I'm gonna buy some Callaways instead of just the garbage I got in the pro shop. It's everyone's starter brand, and they make it a good high end club as well. For whatever reason, drinking might have been involved. They decided that they wanted to buy the Top Golf driving range restaurant chain for a few $1 billion,
Not
like
for
in
whatever reason.
2018.
You know why? Because you just said it yourself. When you're a public company, you have to always be
You have to grow, you have to pretend, right? Yeah.
Yeah.
But turns out those are totally different businesses. Turns out just designing, learning how to angle and the steel precision that you need to interact with the golf ball and hang out with Phil Mickelson shooting clubs. This should be the coolest private company out there. And instead, they're running these driving range restaurant things that were a fad about 5 years ago. The comps are terrible. They're doing that thing some companies do where even though the comps are negative, as long as you keep opening, it gives the illusion of growth. So if you open 10 stores and fewer people go to all the existing stores, those 10 stores will make it look like you're growing. You say, oh, sales were up 4%, because it's you're adding just kind of more units. It's a terrible strategy. Callaway's trying to break up. So anyway, they went on this binge in the late 2019s and added a bunch of clothing companies, added a bunch of stuff. They're trying to break up. And honestly, for Wall Street, as far as they're concerned, any price is okay. If there's a deal out there, the stock goes up to 10. The stock seems kind of scrappy. It seems kind of gutty, but they need the deal a little too much to bet on it. They're just a little too hungry for it right now. And I think that's going to drive the terms up.
Do you think they're more likely to spin something off, or we
They're
have
trying to
another?
spin off. They're trying to spin off they sold one of their shirt units already. They were like 8 shirt companies and then the Top Golf thing. They were original investors in Top Golf, and so they could have turned their original something like a $20 million stake into over $1 billion. And instead, they decided to lever up their core business and buy out all the Top Golfs. That's one of those things that I bet they think about late at night. But now they're kind of chopping it up again. They're shopping the Top Golf restaurants, but in a tough environment, this is another one of those, okay, let's see how the economy is actually operating. If there's deals out there, if you're able to stuff this deal through, even though the comps at Top Golf are not going to recover in this environment, despite the fact, and the real play here, and the reason I would like them if they broke up, the number of rounds being played this year is a record. I think golf's coming back. I think people are going to watch the majors again. I think the Live PGA breakup all of a sudden becomes like these dueling factions, and these All-Star Game majors are going to draw public attention. All that's bullish for golf. Not in a way that's going to drive triple-digit sales for Callaway, but enough that if it was just a golf club company, I'd be really bullish on them. But they're encumbered by this ridiculous restaurant chain, and they need to get rid of it.
All right, let's move on and talk about a stock near and dear to my heart. This is the first stock I ever bought, Jeff, Under Armour.
Is it really? I'm so sorry.
It is.
When did you buy it?
When did I buy it? 2015. So you can see when I bought it right there. No, it wasn't the exact top, but I went to the University of Maryland, which is the home of Under Armour. It is where the founder Kevin Plank
Kevin
went
Plank,
to school
right?
himself. And I thought I gotta support my school, gotta support the team. It didn't work out for me, did it? So this is a chart of the entire history of Under Armour as a public company, of which I am very familiar with. So talk me through what you're seeing here.
Yeah, I remember the Skechers chart that kind of went upward to the right the whole way, and it was bouncy a little bit. But that's how you're creating shareholder value. A chart like this is more of a kind of a tire fire arrangement. It looks a little toxic. It's giving off some smoke there. Call that the Christmas tree of death. If when companies go straight up like that, Peloton frankly has the same problem. They tend to go straight back down just the way they came up. And that's what happened to Under Armour. Plank drank the Kool-Aid a little bit when they were expanding. He has a little bit of a Nike envy. The idea in Under Armour was they were always like, Nike's a running shoe company, and Under Armour was like the tough version of that. So they wanted U Miami. They wanted just badass schools doing tough stuff. And it worked for a while until it didn't. And then, man, it fell apart. And so, a bunch of mistakes, a little scandal here or there. We don't have to bring up much of that stuff. But they report next week. And again, we're in that kind of gray zone where this thing is priced to die. This thing is priced for a super bad economy. They've got sourcing problems. They're hit by sort of a lot of different, the same type of tariff stuff that you had before. But funny thing, or the interesting thing, is that not that exposed to China. And they're pretty liquid relative to where they have been. And they're trading at super historic valuations. I can't make myself buy it because I've just been burned too many times, and the company is kind of too funny for me to take seriously. I love the conference calls. I love the super energetic, shall we say, vibe of Under Armour, but the decision making hasn't been pristine all along. But a fascinating consumer name. We'll see if anyone's at the mall other than at the stores that go from already.
Well, like you said, it's priced for death. So what happens if it doesn't die? I mean, you just named a couple of very attractive reasons to maybe take a flyer here. So let's see what they say next week.
Yeah, totally flyer worthy. But again, no guarantees here. It's just realize what you're getting into. The opposite of that, on Holdings, worst named company in the world. Who calls their company On? That's the entire name of the thing.
Is it On or is it On?
It's On is the ticker.
Yeah, okay.
On is the ticker, which I refer to it just because On sounds like it sounds like an It's an on, On Holdings. It's the Roger Federer shoe company. They've got like 99% of the hot mom share, and they're managing to kind of make the leap into teenagers who are buying them as well. In my vast experience, if they capture the moms and the teens, that's a buy. That's hot. That's how you get those charts like Under Armour. Under Armour did the same thing where they just made the cultural leap, and they were selling to everybody when you bought the stock. The companies don't ramp that way because investors are crazy. They ramp that way because, holy cow, we're capturing just a ton of share. And every once in a while you get a Nike and it sort of just stables out. That stock's been a dog, but it also made people a lot of money over the years. OnCloud is of the names out there. If you wanted to play shoe, if you want to play this sort of high margin fashion game, this is the play. They're Swiss. They do a ton of business in Europe. So they're going to be able to work around their tariffs. They're relatively well diversified in terms of their supply chain. And best of all, they've got the tailwind of taking share. If you're grabbing share, that makes up for a lot of weak economies. So if the economy is pulling back 30%, but I'm taking 20% market share, I don't care that much about the economy. And so, these guys still can win. I kind of want to buy the stock so much. It just hurts. I have a little bit of a personal position, but I want to get long in the portfolio. I'm champing at the bit. I'm like a dog with a bone sitting at the edge of a dock. I want to jump. But we'll see what they report next week. If any of these higher priced kind of, post Lulu fashion brands are going to beat, it's going to be on.
You mentioned the fact that it's Swiss. They also have the whole international tailwind in their favor, right? I mean, the world has been outperforming the U.S. now for most of the year, right? They've got that going for them. $50 is a nice round number. You may have just talked me into it, Jeff. I'm not going to lie. You may have just talked me into this one.
I really think they're going to outperform it. It's the kind of thing that if you get stuck if the stock doesn't work, the company almost certainly will. They're going to be taking share for the foreseeable future. They have such a huge opportunity in clothes right now that, if you take a look at the long-term chart of Lululemon, for instance, it takes a while for these things to generate, but once they do, man, it goes.
All right. Last but not least, the granddaddy of them all, the big kahuna, Walmart, which is, what did we say? We said Thursday morning, right?
It's Thursday morning. Yes.
All right. Is Walmart still the largest private employer, or is that Amazon? It might be Amazon now, but they were largest.
Oh, it's not Amazon. Wash your mouth out with soap. But Amazon is not the biggest retailer in the country. That's shenanigan talk. That these are lies that young people tell each other to make themselves feel good.
Okay, but it is Walmart. It must be Walmart.
Walmart is huge. It's the second largest employer except for the Chinese military. For what that's worth. That's a true fact. People can look it up. Here's the wrap on Walmart. I'm long and I'm a trap long. Everyone long is kind of a trap long because this company for 60 odd years has gone up in big bursts and then it kind of hangs out and does nothing for 10 years. And, everyone who sold, though, eventually regrets it. It's near all-time highs. It hasn't really given that much back, along with Costco, TJX. We talk about them all the time. These big physical retail stores that just have a better model than everyone else. The thing of it, though, and the reason we started with the smart people hating the rally and might as well finish with kind of one of the poster boys of it. It's just too damn expensive. The PE multiple has basically doubled with the stock. You would like the stock to go up because the earnings have been rising a lot. That's not the case here. And it's not going to be the case this week. So you can look past sort of what Spotify, they missed on earnings, couldn't give it less of a crap. Peloton missed by 4 cents. It means nothing to me because the outsized growth and the cash flows matter. Walmart, eventually you're going to have to grow more than 2% a year to justify a 40 multiple, at least, by the old school rules. And that's kind of the quarter they're going to give us. Now, that said, this is better than any government report. You gotta listen to Walmart. I mean, they're like Amazon, only just for consumers. I mean, how's the consumer acting now? These guys are doing like 1.3 billion a day in the US. So they know. They'll tell you. They've got some good answers.
So it's basic math, right? There's two ways for PE ratio to go up, right? The numerator goes up, that's the price, or the denominator goes down, right? That's the earnings. And they have very different implications, obviously. So in this case, the numerator has gone up, right? The price has gone up. So that's just multiple expansion, right? That's not
right. It's multiple expansion for a company that went public in 1970 something. So
hey, don't hold that against them. It's a different business.
I'm not an ageist, except against boomers. I'm just pointing out that I'm not an ageist. Boomers are fine. There's a great boomer company. Walmart, Target, and Kmart were all formed on the same year, 1962. So, hey, go figure. And Kmart, for one gleaming second, was the largest retailer in the world, which was a sidebar to point out that Walmart's been here for a while. And so you don't normally see multiple expansion in a company that has been the largest retailer in the world since 1989.
How bad could that be? How bad could that be?
Not very. Again, I'm long. I don't hate it. I just think it's growing at about 5%. And so this is going to be AI has to start working for someone to make money. And for Walmart, that should be the case. They've really been able to kind of go deeper pocket than Target, and that's enabled them to have better online operations, better execution in the stores. They're taking share, they're better inventoried, and they've just got more options. They also just went profitable on the online side of things. And so all of a sudden, they actually have a viable online business, whereas everyone else is just faking it a little bit. And so people aren't crazy. The advertising business is huge for them. It's just they got to hit on all cylinders for the stock to stay where it is.
All right. So just to sum it up, You like it, you don't love it, you're in it, but you're not married to it.
Yeah,
And
long
yeah,
and timid, long and
long and
afraid.
timid. Okay.
With On, I'm kind of long and
Yeah.
covetous. With Callaway, I just want to see a deal, man, because I really think golf is going to outperform. And I looked at the Titleist, and they're a little expensive. I just think the Callaway, if they break back up and get rid of that ridiculous kind of configuration they have, that stock works higher, and that'd be nice.
All right. All right. Like I said, we'll be back next week. Ideally, I think on Wednesday, we'll be going live to talk about these earnings reports, the ones that have come in, and look ahead to the ones that are coming for the week. And we'll do that each of the next few weeks because we're in it. This is Jeff season. This is retail earnings season. So thanks for watching, everyone. We'll see you next week. Jeff, good luck out there.
Thank you, man. I'm buckling down. I'm in the best shape of my life. Been training for 9 weeks. This is going to be outstanding earnings season.
We'll see Jeff on the Peloton, guys. Adios.